All right, everybody, welcome back to another video here on Financial Friends. You have joined me for another episode of The Dividend Journey, where I talk about dividends, my dividend portfolio, or anything under the sun that has to do with dividends. So thank you very much for clicking on this video. Since you're already here, you might as well hit the like button. Also subscribe if you're not already to join the friend group. We're on the road to 1,000 friends. Hopefully hitting that by the end of this year, and your support really does mean the world. Also comment any comments, questions, concerns, or really anything you want to type down below at any point during this video. And without further ado, why own low dividend yield stocks? So you know that we have been building this portfolio over time, buying dividend stocks, building the portfolio up, and at some point, hopefully being able to live off of this portfolio in retirement or collect the income from it. Now, why would we want something that doesn't have a high yield? Well, first off, let's go ahead and discuss what makes a low yield low, or basically the inverse of that, what makes a high yield high. So you can see here we have two different examples on the left side of your screen. VOO, which is the S&P 500, top 500 companies in the United States, or the Dow Jones Industrial Average ETF, which tracks the Dow Jones, which is the 30 most important or most powerful companies within the United States. Now, you can very clearly see here, you can get a 1.49% dividend yield or a 1.89% dividend yield by simply investing in one of these two. That's a very easy investment, diversified investment. So why bother investing in Apple, John Deere, or FISROX, which is essentially the S&P 500 or total, actually not S&P 500, total market tracking index? Why take a 0.53%, 1.23%, or 1.13% yield with these three particular stocks when I could be getting anywhere from a 2.49 to a 3.99% yield with any of the ones within this red box? Or why not invest in Hershey or Waste Management, which kind of falls among the 1.49 to 1.89, kind of in that range, right? Why not do those? Why invest in these low yield stocks? Well, for all intents and purposes, these are our lower yielding stocks, and this is why. We need to first identify our goal, okay? Do we want income? Do we want growth? Or do we want both? In the case of me, of course, this is a dividend portfolio, so I'm trying to get income, but I also am not looking to strip myself of any potential future growth as I am young. I'm 20 years old. So the question then becomes, how can you get both? Well, first things first, don't set your standards too high. If you have a goal of a dividend yield of 5%, 6%, 7%, or even higher, you're then going to be stripping yourself of the potential of growth. And if you have a goal of no dividend yield or really low, say like 1% or lower, then you're potentially stripping yourself of that upwards income, that scalable, compoundable income. And so you have to diversify properly and then kind of put yourself in the best of both worlds. You're going to want an 11.53% yield from JEPI. You could see that here on the left side of the screen. And you're going to want a 0.53% yield from Apple, which you could see on the right side of your screen. And so for that reason, you're going to get income, although this asset has depreciated roughly 8%, and your $100 was then turned to 92.1 or $92.10, and your $100 in Apple would then grow to $113, but you're just not going to receive the same income. And you can see that on this screen here. With JEPI, JEPI, you're going to be receiving, over the course of the year that the previous examples were within, $4.87. If you invested in Apple, you're going to get a measly 90 cents. But remember, you're going to have $13 in growth with Apple and an actual decline in growth or decline in your initial investment with JEPI. So these are doing, and I wrote down here, two different things. These are doing two completely separate things. One is income focused and one is growth focused. And we need to understand that these are two different things. It's really important to know that most growth stocks are not going to be paying out the big bucks. They have research and development to complete, innovation to have, people to pay so they can continue to scale their business. We think of companies like Procter & Gamble, Unilever. These are massive corporations that simply kick back, relax, and watch the money come in from Ben & Jerry's, Tide, Swiffer. These are big name brands that people know and are going to continue to buy no matter what. There's not much innovation, research, and development that has to go on to maintain something like that. But you take an Apple, a Microsoft. These are big tech companies, that pay dividends, but they're not paying the highest dividend in the stock market. And why? Because they're trying to grow. And so it's important to understand most growth will not be paying out big bucks, and most big buck payers or big dividend payers will not be growing like crazy. Now, these two charts here, completely arbitrary, completely random, literally just drew from my hand, but dividend-focused companies might see some form of growth, but they're not going to see the same potential growth as a, growth company. And you can see that illustrated here very poorly. So, again, the question comes back to why invest in low-yield stocks, and as Hannah Montana or Miley Cyrus would say, it's to get the best of both worlds. And Disney, although as of late not so much maybe, is a perfect example of this. The dividend yield and the range within the last 5 years came in at 0.97% as the average, so below 1%, still a below average or low dividend yield, and a maximum of 2.05% when the price did come down due to the pandemic, but a median of 1.32%. So you're getting that 0.97 to 1.32% depending on, really how you crunch the numbers. And over the last 5 years, the company has appreciated 20% in value. Now, given Apple or put up against Apple, Microsoft, or any of the big dogs, that number is not going to be quite as good. But over the long term, potentially next 10 to 20 years, you're looking at growth and dividends. If that dividend does get reinstated, they currently are not paying one. But the point being, you could find a company that, as Hannah Montana would say, is the best of both worlds. They're continuing to scale, they're continuing to grow their business, and you will see capital appreciation or price appreciation in the stock. This $127 or $121 price will go up. That's something like an Apple, a Google, an Amazon. Or you can invest in something like Procter & Gamble that might not see quite as much growth. Maybe a Johnson & Johnson. They're not going to see quite as much growth, but they play and operate in industries in which you don't have to continue to see growth, to see good cash flows. Cash comes in, the company can then take that cash, reinvest it into whatever they might need to, but pay large sums out to their investors. So the point being, if you want income, go income, but you're not going to see as much growth. If you want growth, go growth, but you're not going to see as much income. And if you want, get the best of both worlds like Hannah Montana and myself. So that's been this video. Thank you so much for watching. I hope all of the dots were connected throughout the course of this video. If I left something and you're not quite sure what the answer is, leave a comment down below. I will be replying to everybody's questions. Make sure to follow TikTok, Instagram, and Twitter at FinFriendsYT. Content is posted there daily. Make sure to check back here on YouTube, Financial Friends. Hit the like button, hit subscribe, hit the bell so you're notified, and I will see you all in the next one. Take care.